studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
This section introduces one of the most important mindset shifts in professional tax planning. As advisors, we often hear clients say things like, "My friend does this. My neighbor gets paid this way. The accountant down the street recommends it." Or perhaps the most common statement of all, "Everyone else is doing it." These comments are understandable. People naturally compare themselves to others. When they hear about a tax strategy that appears to work for someone else, they often assume it should work for them too. But professional tax planning doesn't work that way. And that's exactly why this slide begins with a powerful statement. I don't care what your neighbor's accountant is doing. At first, that statement may sound harsh, but it reflects an important professional principle. The goal of a tax advisor is not to copy strategies. The goal is to determine what is right for the client sitting in front of them. At the center of the slide, we see two neighboring homes. In one house, a business owner is proudly explaining that their accountant recommended taking dividends. In the other house, a client tells their advisor that their neighbor is doing the same thing. This creates a common trap. The client begins comparing their situation to someone else's. But the large red X in the center reminds us that this comparison is often misleading. Because another client's strategy is not necessarily your client's strategy. Every tax recommendation must be based on the specific facts of the individual client. On the left side of the slide, we see examples of common client thinking. People compare themselves to friends, neighbors, business associates, and other entrepreneurs. The assumption is that if a strategy works for someone else, it should work for them too. The problem is that this assumption ignores the details that actually drive tax planning decisions. On the right side of the slide, we see the professional advisor's response. Instead of focusing on what other people are doing, the advisor focuses on facts, client goals, family circumstances, income levels, ownership structures, and future plans. These are the variables that matter. Because tax planning is not about finding the most popular strategy. It is about finding the most appropriate strategy. Notice the comparison box in the center. Another client's strategy does not equal your client's strategy. This is one of the most important lessons in advisory work. Two business owners may look similar from the outside. They may operate similar businesses, earn similar incomes, or live in the same neighborhood. But their planning needs can be completely different. At the bottom of the slide, we see a collection of fingerprints. Each fingerprint is unique, and that serves as a perfect metaphor for clients. Every client has unique facts, unique goals, unique family situations, unique ownership structures, and unique future plans. As a result, every planning recommendation should be tailored to their specific circumstances. The quote at the bottom summarizes the advisor's responsibility perfectly. I don't care what your neighbor's accountant is doing. I care about what is right for your client. That statement captures the essence of professional planning. Advisors should not be influenced by trends, rumors, or stories from other business owners. They should be guided by analysis, by facts, and by the client's objectives. The key lesson from this slide is simple. Stop comparing. Start analyzing. Because successful tax planning is not about copying what works for someone else. It is about discovering what works best for this specific client. And that is where real professional value is created. One of the biggest mistakes in tax planning is assuming that a strategy that works well for one client will automatically work well for another. This slide shows why that assumption is often wrong. At first glance, two business owners may appear very similar. They may own corporations, earn comparable income, operate in the same industry, or even live in the same neighborhood. But once we look beneath the surface, we often discover that their planning needs are completely different. Let's begin with business owner A on the left side of the slide. This individual is 40 years old. They have a young family. Their business is growing. They have a long investment horizon ahead of them, and they are focused on building wealth over the long term. Because of these circumstances, their planning priorities may include creating RRSP room, building future CPP benefits, reinvesting in the business, and accumulating long-term wealth. As a result, a salary-heavy strategy may make sense, not because salary is always better, but because it aligns with this particular client's objectives and circumstances. Now let's compare that with business owner B on the right side of the slide. This individual is 62 years old. Retirement is approaching. Their children are adults. They may already have substantial investments, and their priorities are different. Instead of focusing on long-term accumulation, they may be focused on retirement income, wealth preservation, succession planning, and transferring assets efficiently to the next generation. Because their goals are different, their strategy may also be different. A dividend-focused approach might be more appropriate. Retirement withdrawal planning may become important. Estate planning considerations may move to the forefront, and preserving wealth may take priority over accumulating additional wealth. Notice something important. Neither strategy is universally correct. Neither strategy is universally wrong. Each strategy is appropriate because it matches the client's unique situation. This is the core lesson of professional planning. The goal is not to find the best strategy. The goal is to find the best strategy for this client. At the center of the slide, we see the planning wheel. This visual highlights the factors that drive planning decisions: age, family circumstances, income, goals, retirement timeline, ownership structure, and risk tolerance. These are the variables that matter. When any of these factors change, the recommended strategy may change as well. That is why professional advisors spend so much time gathering information before making recommendations. They are not looking for a generic answer. They are looking for a customized answer. The statement at the bottom summarizes the lesson perfectly. Same corporation, different people, different strategies. This idea is incredibly important. Two clients may own identical corporations, but if their goals are different, their recommended planning strategies may be completely different. The quote beneath the graphic reinforces the advisor's mindset. The best strategy depends on the client, not the trend. Professional advisors do not follow trends. They do not copy what worked for another business owner, and they do not make recommendations based on popular opinions. Instead, they analyze the client's facts and build recommendations around those facts. The key takeaway from this slide is simple. Every recommendation should be driven by the client's circumstances, not by what someone else is doing, not by what worked last year, and not by what appears popular. Because the most effective tax planning strategies are the ones designed specifically for the person sitting across the table. That is what transforms tax planning from generic advice into professional advice. This final slide brings together the most important lesson of this entire section. Professional tax planning is built on facts, not comparisons. The quality of a recommendation depends on the quality of the information used to create it. And that is why great advisors focus on understanding the client rather than copying what someone else is doing. Let's begin with the left side of the slide. This illustrates the wrong approach. The process starts by looking at what a neighbor, friend, or business associate is doing. Next, that strategy is copied. then there is an assumption that the same strategy will produce the same result. And finally, problems begin to appear. Why? Because the strategy was never designed for this client. It was designed for someone else. The danger of this approach is that it relies on assumptions rather than analysis. The advisor may not know the other person's income, their family situation, their ownership structure, their retirement plans, or the details that influence the original recommendation. Without those facts, copying becomes risky, and risky planning often leads to missed opportunities or unintended consequences. Now let's compare that with the right side of the slide. This is the professional planning process. The first step is gathering facts. The advisor collects information about the client's income, family, corporation, assets, goals, and future plans. The second step is analysis. The advisor studies the information and develops a complete understanding of the client's situation. The third step is scenario building. Different planning options are modeled and compared. The fourth step is reviewing outcomes. The advisor evaluates the results, identifies advantages and disadvantages, and considers potential risks. Finally, a recommendation is made. But notice something important. The recommendation is not based on opinions, and it is not based on what someone else is doing. It is based on evidence. At the center of the slide, we see a client-focused advisor surrounded by information: income information, family information, corporate structure, tax projections, retirement goals, risk tolerance, and planning reports. These are the factors that should drive recommendations, not rumors, not trends, and not stories from other business owners. The panel on the right highlights several professional planning questions. What are the client's goals? What is their current and future income? Who owns the corporation? What is their retirement timeline? What planning opportunities exist? These questions form the foundation of quality advice. Because the more we understand about the client, the more effective the recommendation becomes. At the bottom of the slide, we see a comparison between copying and analyzing. Copying leads to assumptions, generic advice, and unknown outcomes. Analyzing leads to personalized planning, evidence-based recommendations, and better decisions. This comparison captures the difference between average planning and professional planning. The message at the bottom summarizes the entire lesson perfectly. Your client's facts matter more than someone else's strategy. That statement should guide every recommendation you make, because every client is different, every situation is different, and every recommendation should be built around the facts of that specific case. The final takeaway from this slide is simple. Focus on facts. Analyze the situation. Build scenarios. Review the evidence. And then deliver the recommendation that best fits the client's objectives. Because the best tax strategy is not the one that worked for someone else. It is the one that works best for the client sitting in front of you. That is the foundation of truly professional tax planning.